Everyone, welcome to AM Finance Academy. So today, now we are going to also that topic. I have said you in the previous video, what is operating leverage? I have said you the meaning of leverage. I have said you the meaning of operating leverage, and I also have financial leverage. So before starting our topic, I want to say that please subscribe my video if you are forgetting that, and don't skip the video because there are a lot of important things especially in this leverage videos as you are going to face the interview especially. So financial leverage and operating leverage are very important things. Operating leverage is related to operation, while financing leverage is related to finance. So you may be working in this field especially, so you have to know this. So let us come to our topic. What is financial leverage? As I have said you, leverage is nothing. It is the presence of presence of fixed charges especially. Where operating leverage, it is related to it is due to the presence of fixed operating charges. Fixed operating charges like machinery, building, or installation of new machinery or something like that, which is related to operation. Okay. So here, coming back to financial leverage, it is related to it is associated with the financing activities. Financing activities means, I want to say this. So financing leverage is, we can say that this is the ability or the capacity of the firm or the company. Okay, this is the ability or capacity of the firm or company to use its fixed financial charges. Fixed financial charges to magnify the effect of change in EPS due to change in Ebitd, or change in Ebitd on change in EPS especially. So here you can see fixed financial charges. That means in financial leverage, why it is financial leverage? Because there is the presence of fixed financial charges. That is, what are the fixed financial charges? I have said you before, that is interest. We have to give fixed percentage of interest to the outsiders or on debenture holders or to bank or to financial institution. That is interest. That is fixed in nature. And another thing is there also, that is preference dividend, which is also fixed in nature. So due to presence of fixed interest or fixed dividend, the financial leverage is there. Okay, so we can say this as financial leverage. In operating leverage especially, it is related to sales. That means sales on Ebitd, the effect of sales on Ebitd, it is in operating leverage. But here, actually financial leverage has nothing to do with especially sales. So it is the effect of Ebitd on EPS especially. EPS means earning per share. The shareholders, how much earning they are earning per one share. That is EPS. Okay, so how we are calculating the EPS? I have said you before, that is EAES, earning availability to the equity shareholders divided by number of outstanding equity shares. Okay, that is EPS. So here in the financial leverage, we can say that this is the percentage change in EPS with the percentage change in Ebitd. That means the effect of Ebitd on EPS. In operating leverage, it is related to the sales, as you know, that is varying, but it is in financial leverage, it is not varying with the sales. So here we are considering the EPS part, Ebitd on EPS. So let us see. So look at this financial leverage. So it is associated with the financing activities of the firm, which results from the presence of fixed financial charges, that is interest and dividend on preference shares. Okay. So it is defined as also the ability of the firm to use its fixed financial charges to magnify the effects of change in Ebitd on change in EPS. As per the Ebitd, how much EPS is changing, this is what we will know from financial leverage. Okay, so how do you calculate the financial leverage or the degree of financial leverage? DFL stands for degree of financial leverage. Okay, so that is percentage change in EPS divided by percentage change in Ebitd. Okay, so if the funding or the finance has been through the equity plus debt, that means if the company is taking finance through both equity and debt, then we will calculate the degree of financial leverage is equal to Ebitd divided by Ebitd minus I. I stands for interest. Ebitd is earning before interest and tax. Before giving interest and tax, the profit we can call it as Ebitd. So degree of financial leverage we will calculate if the equity plus debt is there. So we will calculate that DFL is equal to Ebitd divided by Ebitd minus interest, or I. if the company has been financed through equity, debt as well as preference share. So the degree of financial leverage will be calculated if the company has been financed through equity, debt plus preference share. So we will calculate the degree of financial leverage is equal to Ebitd divided by Ebitd minus I minus dP by 1 minus T. So dP is nothing but preference dividend. We can say I is interest. Here 1 minus T means T is a tax rate. Okay. Okay, see here a example. If the finance manager of a company expects that its EBIT in the current year would be 10,000. That means in the current year, in the present year, EBIT is 10,000. The firm has a 5% bond amounting 40,000. The value of the bond will be 40,000 while the interest on the bond is 5%. Okay, 10% preference share amounting to 20,000. That means preference share is 20,000 or 20,000 having fixed dividend. Fixed percent of dividend, that is 10% on preference share. So what will be its EPS assuming? So what will be the EPS if EBIT will 6,000 or 14,000? That means in the present year we have 10,000 EBIT. If it will reduce to 6,000, what will happen, or what will be the effect of EPS? If EBIT will be rising to 14,000, what will be the effect of EPS on it? Okay. So see here the solution part. So we are, yes, the note is that how would be EPS affected, I have said you. So what will be the EPS? Effect of EPS if EBIT will be 6,000 or 14,000. And the firm is under 35% tax bracket. That means tax is 35%. The number of ordinary outstanding share, here you can see the number of outstanding ordinary share is 1,000. So see the solution part. So here is the particular, here you can see amount and amount. Okay, so see this 10,000 is present year, this 10,000 is present year EBIT, this 6,000 is if the EBIT will reduce to 6,000, and here if the EBIT will be rising to 14,000, what will be the effect on EPS, especially this part EPS. See here how to calculate this. So how we will calculate EPS from EBIT? See here, EBIT, earning before interest and tax. That means before giving interest and tax, our profit is EBIT. If we will deduct interest, we will get EBIT. That means we have given interest, as it is mentioned here. You can see it is mentioned here 5% of a 40,000 bond. We are giving interest here on bond. So 40,000. See 40,000 into 5%. 40,000, 5% of 40,000, that is 2,000. Here, see here, current year 10,000. So 10,000 here is the EBIT. Interest will be 2,000. 40,000 and 5%, that is 2,000. Okay, so then 10,000 minus 2,000, we are getting EBT, that is 8,000. Okay, this is EBT. Okay, so after if we will give the tax, EBT means earning before tax. Okay, if you will deduct tax from that 35%, so 8,000 into 35%, that will be 2,800 is the tax, 35%. So the remaining amount is called as PAT, or profit after tax. You must have studied it in your academics, that is PAT. So PAT is here 5,200. Okay, so after all, I have said you already. At first we have to give to the outsiders, that we have give the interest part, then we will give the tax, and after that we have to give the preference dividend, because they are the preference shareholder. Before giving to shareholder, we have to give them. So preference dividend is here. You can see 20,000, 10% preference share amounting to 20,000. Okay, that means 20,000 into 10%. 10% of 20,000, that is 2,000 again. Here you can see preference dividend is 2,000. The remaining amount is known as, if we deduct preference dividend from the PAT, we will get EAES. Here you can see EAES, earning availability to the equity shareholder, that is 3,200. If the EBIT is 10,000, you can see. Okay, so how you will get EPS? EAES, equity earning availability to equity shareholder, divided by ordinary outstanding share. Here 1000 rupees. So here is the 3000 divided by 1000, that is 3.20 or 3.20. Okay, so here is the EPS, you are getting 3.20. Okay, so just come here. If the EBIT will be reducing to 6000, what will happen? We are giving interest fixed, that is fixed, that will not change. I have said you yesterday, it is fixed financial charges. That was in the previous video. I have said you about the fixed operating charges. So this is fixed financial charges, it will not change also. So here you can see 2000. So if you will deduct that, we will get EBIT 4000. If you will deduct tax from that, that is 35%, or that is 1400. Then we will get PAT, that is 2600. So after that we will give preference dividend 2000. It is also fixed, as it is preference dividend, so it is fixed. 10% of 20,000 is 2000. So after giving preference dividend, we will get 600 as EAS, earning available to the equity shareholder. And how we will get the EPS? EAS divided by ordinary outstanding shares, 1000. 600 by 1000, 0.60. In the same way, if the EBIT will be reducing, or EBIT will be rising 14,000, 10,000 to 14,000, then also we have interest is fixed. So here we are giving 2,000 interest. Also EBIT is 12,000. Okay. So that means if you deduct interest from the EBIT, we will get EBIT. After giving tax 35%, we are getting PAT 7,800. Okay, then after that we have to give preference dividend, which is also again fixed, that is 2000. Then we will get EAS 5800. I will get the EPS, EAS divided by 1000. Here 1000. So 5800 divided by 1000, that is 5.80. We are getting EPS here. So now let us see the effect. What is effect? I have said you number of outstanding equity share 6000 by 1000, 5800 by 1000, and here 3200 by 1000. Okay, so case 1, when EBIT is falling 40%, the EPS is falling 81.25%. See here, when EBIT is falling, here is 10,000, it is 6,000, that means 40% it is reducing. How to calculate that? 10,000 minus 6,000 divided by 10,000, if you into 100, it will get how much percentage it is reducing. So 10,000. So how much it is reducing? 40%. That means EBIT is here reducing to 40%. Okay. So how much the impact of the, see this, EPS was 3.20, now EPS is 0.60. It is reducing 81.25. See here EBIT is reducing 40%. So here EPS is also reducing 81.25%. How to calculate this? This minus this divided by this into 100. You will get 81.25. You can calculate on your own also. Okay, this is percentage change in EPS due to percentage change in EBIT. See here, I have written here. When EBIT is falling 40%, EPS is falling 81.25%. In the same way, when EBIT is rising from 10,000 to 14,000, 10,000 to 14,000, EBIT is rising. The effect you can see, the EPS was 3.20. Now it becomes 5.80. That means EPS is also rising 81.25%. How you can calculate that? I have said you, this minus this or this minus this, you can ignore the minus sign, divided by this into 100. That means current year minus the next year, or the, you can think is, or assume it as the base year. Okay, so base year minus the next year divided by base year into 100. This is the base year, this is the next year. Okay, base year minus next year divided by base year into 100. You will get the percentage change. Okay, so see here I have written you when EBIT is rising 40%, EPS is rising 81.25%. So what will conclude here? Just tell me. So we are not. So now you can see when EPS is this much, EPS is this much, and EPS is this much. See the fixed charges. Fixed charges is here fixed. So how will calculate degree of financial leverage? How will calculate degree of financial leverage? That EBIT by EBIT minus I have said you. See here, EBIT is 6,000. Okay, interest is 2,000. That means 6,000 divided by 6,000 by 6,000 minus 2,000. That means 6,000 by 4,000. 6 by how much you are getting? 4. So if you reduce that, you can get the degree of a financial leverage. You can calculate on your own. Okay. So now you can understood. So when a firm will have more, like the degree of financial leverage, especially you will get that in like 1, 2, 3, something like that. So the firm which has more financial leverage, degree of financial leverage, that firm is said to be more financially leveraged firm. Okay, so that means it is also having high EPS. So like that, like the operating leverage in the financial leverage also same. If financial leverage is good, and if it is good also when EPS is good, EPS is rising. Okay, if financial leverage is also, we can say financial leverage is bad, if EPS will be falling. Okay, so this is all about financial leverage. I have said you in the previous video about operating leverage, and now I am saying you, I have already said you what is financial leverage. In the next part, we will learn about the combined leverage. That is the mix of financial leverage and operating leverage. Okay, so for today, this much. Okay, so if you like this video, if you learn something from this video, share it. Don't forget to subscribe it, like it. And if you have any query, comment down below.